Hey there everyone, Ryan Schul here. Welcome to my channel. Today I want to talk about insurance claims and I want to show you how to make severity predictions, and then based on those predictions you can identify whether or not you can fast track an insurance underwriting decision, right? Or insurance claim, right? If somebody submits a claim, is this legit? Is this a fraudulent claim? First of all, okay, that's what we have to understand. And based on the legitimacy of this claim, can we just fast track it and say, okay, go ahead and make the payment? Or do we have to do further investigations because it looks legit on the surface, but maybe underneath, maybe there's some type of fraud, right? So insurance fraud is a big problem in the United States. I'm not sure about other countries, probably similar in other places, right? If there's money involved, people are going to go get that money, or at least try to, no matter what. So let me show you how to understand severity predictions and then fast track the claims process or intervene and prevent the claims from being paid out, right? So why would we even want to do this? Number one, I mean, just common sense, reducing costs, right? Reducing fraud, exposing fraud, fraud prevention, things like this, fast tracking for the clients that we work with, right? If we can get money to the clients in maybe 24 or 48 hours, they're going to appreciate that, especially if they are in a car accident, now they have no car. If you had a medical condition and you're in the hospital and the hospital administration staff or whatever is coming up to you and asking you to pay bills, right? You need that money pretty quick. You don't want to sit around for months and months, or God forbid, years to wait for those insurance premiums to be paid out, right? And I'm sure you've heard about that in the news not too long ago. This was a very hot topic because there was an incident where a insurance CEO was basically murdered, and I guess when you look back prior to the date of the murder, there was a lot of shady dealings and people were paying their premiums and finally legitimate claims, but the insurance company would just never pay out. They would always come up with an excuse. There was actually a book that was written that came out on the same topic, delay, deny, defend, or something like that. It was 3 Ds. I'm not sure if I got the order right, but I read about half the book. It's pretty interesting. It's pretty sad too. A lot of these insurance companies just refuse to pay no matter what, even if you have a valid claim and is proof beyond reasonable doubt. Sometimes they still don't pay, right? But that's not really good business. That's a whole nother topic for a whole nother day. Let's just say that the claim is legit and the insurance company is legit. And how can we manage this business to make things more optimized, more efficient, more streamlined, things like that, okay? I've been in Wall Street for 20 years. Most of my focus for 2 decades was streamlining, efficiency, process improvements, automation. Recently, I got more into AI, machine learning types of things. So if we can use some type of ML practice or DL, which is deep learning, or data science, or some type of AI intervention to understand who needs to be paid when, where, how, why, things like that. That's a huge win for the customers. They're going to love it. They're going to appreciate it and tell their friends, hey, I had a great experience with this insurance company, even though I had an accident. And accidents are just accidents. You can't prevent that. You can't anticipate that. Right? But if you have an accident and you're paying your claims up to that point, the insurance company should pay you. So let's see how they can do this quickly and efficiently. So Control Enter to run the cell, and I'll share all this code with you guys. So you don't have to worry about writing it down on a piece of paper with your pencil and understand every nuance and detail about the claim. No, it's not like that. Like, I'll share all the code with you so you have everything. You can copy and paste it into your own Jupyter notebook environment and run it as is, and you'll get some very interesting results, which should match my results perfectly. But then again, if you want to go ahead and make some modifications or changes to the scenario, by all means, go for it. So we have the setup here. We have auto, home, commercial. Commercial is like big businesses, right? Home is home and auto is auto. So it's pretty obvious. Collision, glass, theft, liability, water, fire, liability, property, and workers' comp. Okay, so it's several different types of insurance. So this should be a pretty interesting exercise. So we're going to go ahead and create a baseline severity for each of these types of insurance claims. So we could have, in terms of severity, maybe no severity. Maybe there's a claim, but almost no injury, no real need for the insurance company to pay out. Maybe there is minor injury and the insurance company needs to pay some small amount. Maybe there's major injury and the insurance company has to cough up a big chunk of change, right, and make good on the contract. So based on the severity, let's say there is an injury, and how severe is the injury. Again, it could be pretty minor, a couple scrapes and scratches, nothing material. It could be more serious, fire, water, workers' comp, minor, major, right? So I'm assigning different values to these types of severity events, and we're going to try to understand, is the event serious or not so serious? And if it's serious, exactly how serious is this thing? Okay, is it pretty minor? Is it intermediate? Is it major? So I have the lines of business over here: claims type, injury severity, coverage limit, time to report days prior claims in the past 3 years, yes or no. Policyholder tenure, how long have they been a member with us or a customer with the insurance firm? Fraud risk, age of the asset, right? Newer assets are worth more, older assets are worth less. Number of vehicles involved in the accident, if this is an auto claim, claim amount reported, okay, and it could be anything from small hundreds to thousands to tens of thousands, maybe hundreds of thousands. Probably not for an automobile, unless maybe you have a high-end sports car, but certainly for medical, it can climb into hundreds of thousands of dollars very quickly. So yes, I wanted to display this if I put that in, but I didn't. So let me swing back and get that. So let's look at this. Let's take a look and see what this data frame looks like here. So we have severity amount and then severity bucket. Okay, so these are the features that we are working on here. And display df.head. Did I not click that? I thought I just clicked it. Give me a sec here. Okay, so, oh yeah, it's running, Didn't look like it's running, it is. So let's give this a minute to finish up. I am going to hit the pause button for a second and I'll be back in just a bit. All right, now, so we have our data frame here, and this looks basically to be in pretty decent shape. So we have the lines of business, claim type, severity of injury, coverage type, so on and so forth, all the way over to claims, reported amount, severity, amount true, and then severity bucket and lows and highs for the bucket, right? So that looks good. So let's go ahead and take some machine learning opportunities here to go ahead and dissect this information further. And we're going to take everything, feed it into an algorithm that is going to help us determine how accurate this model is in terms of making predictions into the future on unseen data, right? So the key here is we have our training and our testing set. So here's the train, here's the test, Y train, X train, Y test, X test, right? So these are the independent variables. These are all the categorical columns, and this is the dependent variable, right? This is what we're trying to predict. This is the severity bucket. So given all of the independent features or columns that we looked at before, we're trying to predict how severe is an injury, and this model is going to help us do that. And we also have to look at how accurate the model is in terms of making predictions too, okay? So we have to train and test the model right here. That's where we're going to do that. And then in that process, we're going to have a holdout set. So here's the training set, training with X and Y. The testing is right here. That's the holdout set. We're going to measure what the model predicted against what those actual values actually were, okay? So when we run the model, and you can see this is RandomForest classifier right here. CLF is the name of the model. I fit it right here. Or rather, sorry, here's the pipeline. So pipe is right here. So process and model, this is a classifier, and this is the process. We go ahead and fit it. So pipe.fit, pipe comes from here, classifier comes from here, and that is short for this. Just so we don't have to go ahead and retype out everything. We just assign an alias name to the classifier and we get this. So overall 96.2% accurate. That means about 96% of the time it is making an accurate estimate or an accurate determination about the severity of the accident. Okay, and maybe 4% of the time it's going to make a mistake. It's going to say the accident is severe and it's not, or vice versa. So it's pretty hard to get up to 100%. You can do that by using a couple different techniques. I'm not going to get into it in this video. I have other videos that speak specifically to that topic. So let's go ahead and get predicted severities for all the rows. So we know overall the model is pretty precise. The recall F1 score, we want these to be close to 1.0. It is. We want the accuracy to be pretty high, and it is. It's close to 1.0. So let's go ahead and predict the score for every single row in the data frame. So I'm going to say down here, if severity is low and fraud is less than 0.35 and injury equals none, and amount is less than 5,000, and we're going to fast track it. So it doesn't look like fraud. It looks like pretty low severity, pretty minor injuries. We don't have to spend a ton of time evaluating what the next step is here. Okay, so I started my career in insurance many, many, many years ago, a couple of decades ago, and I remember we would spend so much time reviewing all these cases. Do we pay? Do we not pay? How are we paying? How much? Why? When? Where? How? Which? Where? All these things have spent just tons and tons of time trying to evaluate the whole process of making good on the claims and then deciding how much we're going to pay, right? So if we had these kind of models 20 years ago, I would be flying through my work like nothing, right? I would spend hour after hour after hour. The whole team was just grinding away all the time, trying to determine like how severe is this injury? Are we going to pay? Yes, no. Are we going to pay a lot? Are we going to pay a little? What is the overall triage, right? If we have the model like this, we can figure out very quickly in a matter of minutes, maybe even less than 1 minute, is this something that the insurance company is going to pay out? How much, when, where, how, why? We can answer all these questions very quickly and easily. Let's take a look at this whole output right here from a slightly different perspective. I want to know the low and the medium in terms of severity of the claims, and then the triage decision. Is this going to be a complex scenario, fast track it, or is this going to be a standard like review of the contract and evaluate the injury and the extent of the injury occurred there? So we have to go ahead now and calibrate the threshold to try to determine, is there fraud or not? If there's fraud, then we have to expose this and prevent fraud from interfering with paying the claim, right? So we can measure fraud a couple of different ways, and we're going to use just a very basic, simplistic setup right here. If this was going to be in a production environment, I would probably spend a little more time and do just a tad more due diligence and quantify the scenario a little bit better here. But I think for our purposes today, just for a teaching opportunity or teaching lesson, whatever you want to call this thing, I think this is good enough. So if the severity prediction is low and the fraud risk score is less than the fraud cutoff, okay, so if it's under a certain threshold and the injury severity is none, we can go ahead and say claim amount reported and the amount cut. This is basically the check. How much are we going to make the check out to for the client or the customer or the policyholder? How much do we pay to them? Okay, so that's the setup here. We have the fraud cut. This is the amount that we're going to pay. The fast track share, the miscellaneous high amount in absolute terms, and the miscellaneous high rate. So when we create a data frame here, we can see the fraud cut amount, the fast track share, high miss absolute value, and miscellaneous high rate. And we have mostly zeros over here, mostly zeros, so nothing really to be concerned about. Let's look at this from a different perspective. This is a regression model now, so I'm using a RandomForest regressor right here. Just above, I was using a RandomForest classifier, so this is the classifier right here. Okay, and this comes from this library when we import this right here from sklearn. Ensemble import RandomForest classifier goes down here. We assign this alias name classifier. Same thing with the regressor down here. We have RandomForest regressor. We are importing the library and we are assigning that regressor this name, RandomForest. If I go Control F, you can see that the pipeline right here is using RandomForest regressor and the pre-processing regressor. We take this whole pipeline, Control F, Control C, Control V, pipeline regulation fit. We always fit the model X train regression, Y train regression. If you go back here, you'll see essentially the same thing. Fit is done right here, X train, Y train. Okay, that's the pipeline for the classifier. This is the pipeline for the regressor, X train, Y train. Okay, hopefully that makes sense. If not, Google it, talk to ChatGPT. I'm not going to get extremely into detail here because there's so many videos that already speak to these topics, but just suffice it to say we have a 92.7% R squared, or 0.927 R squared, sorry, misspoke, 0.927 R squared, which is pretty high. 1.0 is perfect. As we get higher and higher, we are more satisfied that the model is making more accurate predictions. and we're more confident and more comfortable with the outcome. If it's a little bit lower, like 0.8, even high sevens or 0.70, that is more of a concern because the model can make more mistakes going forward. In this case, 92.7% of the time, the model is making the right determination and the correct output here. It's generating the correct output, but again, still about 8% of the time, it's going to make a mistake. And just like human beings, we all make mistakes sometimes, right? You can get this number up closer to 1.0. The goal of this video is not to do that, but then you have to make sure that you don't overfit the model. If you have a very high 0.9999 R squared, you might be overfitting the model, and that could be detrimental to making future predictions too. If the model learns all the nuances of the underlying data, but can't really discover the patterns of the data, it's probably not going to make accurate predictions on unseen data that it's never been exposed to before. So just be aware of that. So now we're going to go ahead and calculate the severity predicted amount, okay? And we're going to put this into a couple different bins, 0 up to 3,000, 3,000 to 1,500, and then over 1,500. So the first bin, this right here would be low. This is the second bin, this would be medium. And from 15,000 up to whatever, the maximum claim is going to be high, high amount claimed on the insurance. So all this gets appended into the data frame. If you go back here, you can see we started with severity amount true. So that comes from over here. Okay, then we had severity bucket, severity prediction, and decision triage. That came from all of the original data frame. So you can see over here, decision triage, severity amount, severity predicted amount, and then severity bucket predicted amount. Okay, so that looks fine over there. Let's move on to the next step. So now we're going to look at auto, home, and commercial. All of these are going to be bundled together, and we have line of business rules right here that we're going to create a data frame. First, we have our dictionary with our keys on the left. Okay, and these values are on the right. So this is a key value pair. Okay, and these are going to sum up to 100% of the business. We have 0.35, 0.25. So that would be 0.4, right? Wait, 0.35 and 3,500, 35, 65. Yeah, so we have 100%, and then these would be the cutoff amounts over here. So we have the line of business, fraud, yes or no. What is the amount of the injury and or the extent of the injury? Is it serious or not quite so serious? And then the amount predicted that's going to be paid out. So let's hit Control Enter over here to run it. So we have the good old data frame that we had before, going up to severity bucket predetermined amount. So we see that down here, severity predetermined amount. Now we have the triage line of business. Now this is how we're going to try to help the business to run more efficiently, more streamlined, less manual, less prone to human error, and just say, listen, if the risk falls into this bucket or this, this is going to be a standard payout. This is going to be fast tracked, yes or no. Okay, so we're setting up these business rules. We're setting up these guardrails, right? So we're going to operate within the guardrails and within those parameters that we know are safe, and then go ahead and assign these different claims to different buckets. So we can say this is going to be fast track. This is going to be paid out in 24 hours, maybe 48 hours, maybe there probably would be like a minimum time period to go ahead and do the analysis. Even if it's fast tracked, I don't think you're going to get paid the same day that you submit a claim, but maybe within 24 to 48 hours. I think that's plausible. I think we could accomplish that. Where I used to work, it would take, oh my goodness, weeks, sometimes even months for something that should have been a fast track, but they just couldn't do it. They didn't have the model. They didn't have the quantitative capacity to do that. They didn't have the automation, the workflows, the work streams that we have nowadays, right? So 20 years ago, that would be an absolute blessing, but just didn't exist. It wasn't part of the business 20 years ago. So summarize quantity per line of business. So we can take it and this and go ahead and do a group by and aggregate the numbers. We're looking at counts and means. So over here we have the line of business, the triage line of business. Is it complex? Is it fast track, or is it standard? So fast track is going to go out pretty quick. Those guys are going to get paid probably within a couple of days. Standard, the review turnaround is going to be a little bit more, maybe a week, a couple of weeks. If it's a complex claim, it's going to take significantly longer because there's so many different variables that need to be considered. And almost without exception, these complex cases are going to be high value cases too, right? If somebody submits a claim for 5,000 and there's an auto accident reported, confirmed by the police, and the automobile was intact yesterday, there was an accident today, probably tomorrow we can pay the person if you show us evidence of the automobile accident. That's not a complex case. It's fast track. That's very straightforward. If there was a whole bunch of vehicles involved in the accident, several people got injured, people could have had pre-existing conditions. Maybe somebody had a neck injury from some other some other incident, who knows what. Then they're claiming neck pain during this this accident, and they want to be indemnified doubly, right? Called double indemnification. Then that gets a little bit more complex, right? So that would probably be a standard review. If somebody already filed an insurance claim and had a neck injury, and now they claim they have another neck injury, you can't pay that person again if it's not a real injury. But they could have had an initial injury. But the second one, you have to prove that that's real, okay? So I'm not going to get into all the legal ramifications of that. That's not what this video is about. But just understand, so you have 3 lines of business: auto, commercial, and home, complex, fast track, and standard types of claims and payouts. So over here, we can look at the true severity inside each triage bin per LOB, which is line of business. So anything that's complex, fast track, standardized would look like this. So this would be the lower threshold of the severity, and this would be like a medium kind of threshold. So fast track, standard, medium actually has nothing over here, and standard has nothing over here. Okay, so on the lower end, there might be more claims. There might be more claims falling into these low end buckets. And it looks like down here we kind of repeat the same pattern: 1.0, 1.0, and medium over here on the right is kind of in its own separate category. And for home, you can see over here, the complex cases make up about 36%. The lower lower claims amounts fall into this bucket over here. Commercial 0.82, 0.17, and auto for low and medium for auto is different too, right? So they follow somewhat of the same pattern, but they're always slightly different too. So now we hear here we have the fast track, 11.6%, which is calculated by the arrivals per type of claim being filed, divided by the number of days times the work hours per day. So this is work hours per day, basically how efficiently we are producing results for all of these claims. So most of these are coming out as fast track, which is good. It's a pretty simple, pretty straightforward claim. Nothing really to negotiate, nothing to argue about. It was an accident. The person had a contract with us. We have to indemnify the person and make good on the promise that we had written up in the contract. The contract is a contract, right? Once you have that contract in place, that's not negotiable. You can't say, well, I know you hit the car. If you had hit the car just a little bit on the side, we're going to pay you. But since you hit the car a little bit at an angle that we didn't really expect, we're not going to pay. You can't do that, right? That's not how those contracts work. If you have an accident, you make a claim and the insurance company pays. The only question here is it could be a fast track, so it's paid out pretty quickly within a day or so, or there's going to be a standard review and we'll probably pay out within 1 to 2 weeks. Or is it more of a complex case? You can see the complex cases are far lower than the fast track and the standard. So these require more due diligence, more attention, more introspection, more review by senior claims adjusters and so on and so forth. So let me go ahead and create a chart here. A chart is a great way to visualize the data. I always say a picture is worth 1,000 words. If you take all the analysis that we did above and then prepare that for a chart, that should jump off the page and just really pop for you and say, okay, based on the amount cut and the fraud cut and the fast track share, show me a chart that visually illustrates what's happening here with these payouts, okay? So basically, the brighter the color, the more fast tracking we have of these policies, and the more are being aggregated, or the more aggressive payouts the insurance company is paying more frequently and faster, and it's less restrictive. If you have a fraud cutoff, like around 0.5, and the amount cutoff is for 10,000, you can fast track some of the claims, right? If it's lower than the amount cutoff, those can be fast tracked. If the amount being claimed to the insurance company, the payout requested from the insurance company is over 10,000. Those might fall into a different bucket. Those might be standard review or even a complex review. Anything under 2K can probably be paid out very quickly. Probably it's not a lot of fraud, although that doesn't mean there's no fraud. A person could still understand that the cutoff threshold is 2,000. They're going to submit a claim for 1,950. You can't just automatically say this is a fast track and we're going to pay it. There could be some fraud involved there, but I would argue that not too many people are going to waste their time chasing 2K. If it's over 10K, you'll probably see more potential fraud show up here, right? If somebody's found a claim for 100K, 500K, a million, that could easily be fraud. It could be justifiable, but that could be fraud too. If you can easily get 2,000, it's probably not worth a lot of scammers' time or fraudsters' time. If they can get 1 million, it's probably worth your time, right? They're going to put a little more thought and effort into the scam and try to get a payout. So here we can see on the x-axis, the sum of fast track share is increasing slightly as we move over to the right, and the fraud cutoff increases, right? So down here, we're saying pretty much no fraud. Here we could have some fraud just because the amounts that are being paid out are higher. And you get over to the right, now you have a much higher payout, up to 14,000. So the fast tracks are going to be not so fast at this point, right? We're going to be pumping the brakes over 12,000. You can see the colors kind of cut off right there, and over to the right, they're all darker. These guys are not being fast tracked just because the claim is higher. It needs to be going through a standard review or maybe a more comprehensive review of the claims adjuster. So let me hit the Control Enter here to refresh the cell, and we're almost at the end, so hang in there for another minute or so. So we're going to look at the triage over here based on the line of business and the triage LOB right there. LOB is short for line of business. I want to look at the line of business itself. The count is going to be on the x-axis. Line of business is on horizontal. You can flip those two. You can reverse it to make the x the count and the y the line of business. If you wanted to do that, you can actually do that. But usually this way is a little bit more funky looking. It doesn't kind of like have the same effect as you would normally see with a vertical chart. It's really up to the end user, but you want to tell a story that's convincing and compelling and really, make sure that you communicate the message that you intend to, right? I think with these types of things, the vertical stack bar makes a little bit more sense. I think this is a little bit more intuitive. So you can see here the three different colors are represented by standard, complex, and fast track. So a lot of these are fast tracked. The general relative dominant amount here for auto policies are fast tracked. Some are standard reviews. The smaller amount, up to 297 claims, are actually complex. So it's going to require more time, more effort, more labor from the claims adjuster. Over here, you can see 209 and 238. So here the standard is a little bit higher, but still quite a few are fast tracked, and also only 46 line of business. Remember, this is commercial. Only 46 are complex. Down here, 139 complex. This looks like 783 fast tracked and standard 536. So that's it. That's it, guys. So that's my take on helping insurance companies to be more efficient, more streamlined, more automated, right? If you have a pretty straightforward claim, not a lot of money being requested from the claimant, go ahead and fast track it, right? If it's legit, if you've seen a lot of other cases that set precedent, in this case, falls into that bucket, and it's extremely similar to all the prior cases. Fast track it, save yourself some time, and build goodwill with the customer. If it's kind of in between, there's a little more questions that need to be discovered, and we have to just do a little more due diligence, then do the standard review, probably 1 to 2 weeks, and then make a payout or not, right? If you deny it, you have to justify why. And you can see some of these cases require a more complex, thorough review, which could take, I'm just guessing, over 2 weeks, a month, maybe even more than a month in some cases. And it's just going to require a lot more due diligence, a lot more effort, a lot more labor that goes into these complex review cases. Okay, so that's it. That's my take on this. So some data science, some machine learning. We looked at RandomForest regressor, RandomForest classifier, looked at bucketing these different claims, and then using some automation techniques and just kind of common sense and just business intuition to determine how we can run this insurance, this arm of the insurance company in a more efficient manner, right? So that's it, guys. Thanks for your time. I appreciate it. Thanks for sticking through to the end. I'm going to wrap it up here. I will share all the code with you guys, and I will post that when I post the video. That's going to go up a little bit later today. And there you go. That's it. That's my take on insurance claims and predicting severity and fast tracking these claims. Okay, so that's it, guys. Thanks again, and I'll talk to you soon. Bye for now.